Welcome to Atlas Market Intelligence. On today's briefing, our focus remains on the geopolitical shock ripples across the foreign exchange markets, particularly the pressures the Aussie and Kiwi dollar are currently experiencing. This is no longer just a Middle East headline. It's now a currency market story. The Australian dollar and New Zealand dollar are under pressure as escalating conflict involving Iran triggers a classic global risk-off shift, sending capital flowing straight back into the US dollar. Here's what's really happening beneath the surface. In early trading this week, AUD/USD slid sharply, reversing recent gains and breaking below key technical levels. NZD/USD followed closely behind, as New Zealand equities opened lower and broader risk appetite faded. This is textbook behavior in periods of geopolitical escalation. High beta currencies get sold, safe havens get bid, volatility expands. The catalyst? A major US-Israeli strike on Iranian leadership targets, followed by Iranian counterattacks, and growing fears of a broader regional conflict. Markets don't wait for certainty, they price risk immediately. As uncertainty rose, investors rotated into perceived stability: US dollar, Japanese yen, Swiss franc. Commodity-linked currencies like the Aussie and Kiwi, typically tied to global growth sentiment, were sold aggressively. This isn't about Australia or New Zealand specifically. It's about global capital positioning. When risk rises, liquidity concentrates in reserve currencies. The situation becomes more complex when you consider oil. The Strait of Hormuz, one of the most critical oil transit choke points globally, is back in focus. Any perceived threat to supply pushes crude higher, and rising oil prices create a double impact. They increase global inflation risk. They suppress growth expectations. That combination is toxic for risk assets. Higher energy costs feed inflation while simultaneously tightening financial conditions, a difficult balance for central banks. This is not just an FX fluctuation. It's part of a wider repricing across equities, high beta currencies, travel and tourism stocks, commodity-sensitive assets. For Australia and New Zealand specifically, slowing global growth expectations can weaken export demand, and rising imported energy costs may complicate domestic inflation dynamics. That matters for interest rate paths, and rate expectations drive currency valuation. What this means going forward. Right now, markets are pricing elevated geopolitical risk premium, continued energy volatility, stronger safe haven demand, softer high beta FX. If tensions persist, expect ongoing pressure on AUD and NZD, higher volatility in oil, defensive positioning across global portfolios. However, if diplomatic channels open or escalation cools, the risk premium could unwind just as quickly. Markets move on flows, not narratives. This is not about fear, it's about positioning. When geopolitical uncertainty rises, capital consolidates into safety. AUD and NZD are not weak because their economies suddenly changed overnight. They are weaker because global liquidity is rotating. And in macro, liquidity is everything. The Iran escalation has spilled directly into currency markets.
Geopolitical tensions
Risk
are escalating,
appetite has
driving
faded.
oil prices higher amid
Safe
supply
havens are
fears.
firm.
This volatility is intense,
Energy
adjusting my
volatility is
positions.
back on the table. And until clarity emerges, expect defensive capital flows to dominate. Until next time, stay positioned, stay disciplined. This is Atlas Market Intelligence.